Hello, and welcome to Miss Accounting Tutor's presentation on periodic inventory system journal entries for sales. My name is Mary J. Collins, and I'll be your host. A merchandising enterprise is a company that resells items purchased from a supplier to the public. During the process of selling merchandise, the company must keep track of cost of goods sold to the customer as well as the sales price. The cost of goods sold is the price the retailer paid the supplier for the merchandise sold to the customer. The sales price is the amount the customer pays the retailer for the goods. In the periodic inventory system, we record adjusting entries to recognize the cost of goods sold for inventory. Components and format of a journal entry. We start with the date column, which has the month and day. The year will either be on the outside of the book or at the very beginning of the year. Account title and description. You have at least one account debited and one account credited, and a short description of the transaction. Make it concise. The debits always go first, and the credits always go second, with the account title being indented. Sale of merchandise. A sale of merchandise to a customer on credit. This activity requires one journal entry which increases accounts receivable and increases revenue. The cost of the inventory will be handled at the end of the year with adjusting entries. Let's look at an example. January 7th, date in the date column, sold on account, so that will be our accounts receivable, and our sales revenue. Our description is to record sales. The amount was for $800, so we will increase our accounts receivable, which is an asset account, by $800, and we will increase our sales revenue, which is the stockholders' equity account, by $800. This is the journal entry to record a sale under the periodic system. Sales returns. Customers returned defective and undesired merchandise to the seller on January 12th, so we'll do 1/12. Return one of the dogs, so we'll do sales returns and allowance, which is a contra revenue account, and we will reduce the asset account, accounts receivable. Return of one dog. The amount was for $400, so we will increase the sales returns and allowance account, and we will decrease the accounts receivable account. A credit would decrease accounts receivable. And this is a journal entry to record sales returns and allowance. Customer payments. Cash payments made by customers for merchandise purchased on credit at an earlier date with a cash discount for early payment. We have the date, January 17th. Note that this is exactly 10 days after the purchase. Receive payment, so we're going to get cash. We're going to give a 2% sales discount, and we're going to remove it from the books by crediting accounts receivable. Receive payment from customers. So $400 times 2% is $8. And we'll start with the $400 to remove it from the accounts receivable, and then we will debit the sales discounts, which will increase that by $8. This is also a contra revenue account. And then the difference between the $400 minus the $8 will be the $392 that we receive in cash from the customer. This is how we record when they pay within the discount period. Now, here's how we record it when they miss the discount period. So January 27th, 1/27, receive payment, so we'll do cash, and then we'll just credit accounts receivable. And as you can see, we have our accounts receivable T account here. On the 1st, on January 7th, we sold $800. We had a return on the 12th, leaving us a balance on the 12th of $400, and then they paid it on the 27th. therefore leaving a zero balance. It's the $400, so we'll debit cash and credit accounts receivable for the full amount. And the explanation is received payment from customer. That ends our presentation on sales. Here's a list of common accounts, titles, and placed in categories. Here is the periodic inventory sales journal, job aid. And here is my website, which C&M students can use. All you need is a username and password. Thank you very much for your interest, and I hope to see you on other videos.